Hi, I'm Jarrett Lau, the founder of Profitable Properties Boston. Sometimes financing, you have to get creative. It's not always possible to either get a mortgage, maybe someone's lost a job or you're in between jobs, or even down payment sometimes. Commercial banks will ask for 25%, which is a significant amount when we're purchasing properties in Boston that are very expensive. Many times I've actually figured out how to do creative financing. Now there's different kinds, there's hard money lenders, but in today's video, I'm actually going to be covering seller's finance and the benefits to both sides. And remember, in any type of negotiation, you want both sides to feel like they're winning. What is seller financing? Seller financing is when the other seller has paid off a property and they don't owe a bank. And even if they do owe a bank, they can still do some seller financing, but really to a lesser degree depending upon the purchase price and how much they might have on a loan. But just for the sake of this conversation, we're going to be talking about a property owner that might own a $500,000 property and not owe anything on it. So if my buyer wants to purchase this property, let's just say they've agreed to a price of $600,000. Is that our client, my buyer, will go out and get financing from a bank. That bank will ask for a down payment from them, and then they'll actually give them the rest. So the bank might ask for the 25% of the $600,000, and then they'll give the rest or the entire amount of $600,000 to the actual. Now that doesn't actually benefit the seller because they're gonna get taxed a huge amount at the beginning because they're getting $600,000. Whereas if they do seller financing, what they're doing is that they're now stepping in as the bank. They're gonna take the down payment of that 20 or 25% or whatever amount that's negotiated, and then they're gonna collect monthly payment. Now, this is awesome for both sides because A, there's gonna be less underwriting. The banks many times will have to do appraisals and determine if the value of the property is a certain amount, and they might only lend based upon that amount. Whereas if you're a seller, you can say, yeah, I'm gonna give you a loan. You can give them a loan for the whole amount, a small amount, whatever it is that you guys decide. And interest rates, right? Interest rates will fluctuate with commercial banks, and you're gonna have to lock things in. Whereas again, with a seller, you can say, hey, will you do 2%, 3%, and it could be better terms than somewhere else. The best part of it though is for the seller. The seller will actually get this interest. So the way banks make money is that they will lend out money, and then charge a percentage, say 4 or 5% on that money. And over the course of X amount of time periods, which is called the amortization period, 20, 30 years, they're raking in hundreds of thousands of dollars of interest. And that's really how banks stay afloat. They're gonna take money in, they're gonna give you a percent or two on a money market or a savings account, and then they're gonna charge 4 or 5% when it comes to a loan. So they're just using your money to actually leverage and to be able to make money for the bank. Let's step back, and when you have a seller, now they're making the interest. So that initial price of say $600,000, if they got that from the bank, all they would get is that $600,000. But if you take a look at like an amortization chart, even at the $600,000 at a basic interest rate, they're gonna literally make over $100, $150, maybe even $200,000 in interest over the course of it. It means the true value that they're gonna get in their pocket at the end of 20 or 30 years, maybe $800,000 or more. So if you can sell that to a seller and be confident that their property is a good property. Now, of course, there's always going to be risk with every single situation. In this scenario, the seller is taking the risk that if the buyer does not pay for the property, that they more or less won't get paid. But just like a bank, they can foreclose, and if they have the attorneys in the states possible, they're gonna take the property back, and frankly, they could just sell it again. It's a process that they have to go through, but it's a process that really is a win-win situation. We've dealt with clients that wasn't able to get a mortgage, were able to negotiate with the seller, have them make a couple of $100,000 more on interest over the course of the loan, give them the financing of it. And to date, these people are still paying off the loans and everybody's happy. They're getting more money in that they would have ever gotten before. The buyer didn't have to obtain financing, and the transaction was complete. Otherwise, it would have been a dead deal, and that's really not what anybody's trying to go for. That's a brief recap of what seller financing is. I hope you found value in it. And if you or anyone else that you know is looking for a profitable property and a real estate agent that takes a step beyond to think about how to make deals get done and be creative, feel free to reach out to us, as I'd love to help you out.